I want to get your take on what we're seeing in the futures market. A lot of pushing and pulling, whether it's the Fed cut that a lot of people think was hawkish, the trade deal, big tech earnings. Why do you think it's so muted when we're looking at the S&P and honestly even the NASDAQ? While it's in the green, it's just slightly in the green.
Yeah, I think the Fed rate discussion is probably the most important. And a lot of that movement, I think, happened yesterday before the close. So I think that's probably priced in. And the tech earnings, as you just mentioned, were pretty mixed yesterday.
All right. So a lot of people are interpreting what Jay Powell had to say as a hawkish cut because he said a December cut's not definite. But isn't that the same thing as data dependent? We continue to hear Jay Powell say we're data dependent. There's a lot of data to consider and a lot of data missing at the same time. We don't have the jobs report, not clear about the next inflation report, but we do have a lot of corporate announcements about layoffs. And that answers the question, does the Fed pay attention to that? Why do you think people are taking it so hawkishly when it's very similar to being data dependent?
Yeah, and it's interesting. Going into the press conference yesterday, the market was pricing in a 95% probability of a December cut. It's about 70 right now. I just looked at it a minute ago, and it didn't move initially when he said that it was not a foregone conclusion that they were going to cut in December. But then he reiterated that later and said, every meeting we say that the outcome isn't predetermined. But then he went on to say it's not a foregone conclusion. I'm saying something additional this time. And that it's far from a foregone conclusion. That's when you really saw the rate cut probabilities for December drop.
All right. Another headline a lot of people were paying attention to was the end of quantitative tightening. But if you look at some reactions from some different people who are market participants, a lot of people are taking the end of QT as being very similar to a December rate cut. Do you take that stance as well? It's pretty much the same thing?
It's certainly directionally similar, yeah. It's been odd that the Fed's been engaging in QT at the same time it's been cutting rates. That's not a normal situation because those are two things that work in different directions.
All right. One of the other headlines that I really paid attention to was Jay Powell saying that this cut was about stimulating demand. Do you believe it can stimulate demand? Because the demand seems to be weaker on the lower end of the curve. Two cuts, in all fairness, but do two cuts stimulate demand when it comes to lower income people, middle income people?
Certainly correct, and Chair Powell emphasized this in his press conference, that we're seeing stronger demand at the upper end of the income curve. And, we've seen some credit issues at the lower end of the income spectrum. So, 50 basis points doesn't seem like a lot, but that will help with, auto loans and credit cards where we've seen some delinquencies.
All right. So with all that in mind, where do you think that investors should put new money to work? I mean, the markets are trading very close to all-time highs still, even after yesterday where there was so much pushing and pulling. Where are you seeing the potential upside when we're looking at the market for the rest of this year?
The consumer's held up remarkably well. Consumer sentiment is weak, but the consumer keeps spending, and real wages have been positive since June of 2023. So we'd be looking at that upper-end consumer, but probably trading down a little bit in looking for some value. So one name that I'd look at maybe is like a Shark Ninja. Upper-end premium appliances at maybe a little lower price point than some of their competitors, capital light model. So I like the upper-end consumer maybe trading down for value.
One other thing we got to talk about is gold. We got a trade deal cut, a lot of pushing and pulling again in the market. We had Jeff Gundlach on our air yesterday saying it might be time to fade this gold rally. Do you agree? Do you see more upside for gold, or the fact that we're seeing the U.S. and China seemingly having some very friendly relations, does that at least take some steam off that rally?
It certainly could, and I watched Jeff yesterday. I think he's right, as he often is. He said it's probably more of a 50-50 odds of a rate cut in December. A more hawkish Fed would be bearish for gold, and it would lead to a stronger dollar.
One last question. Speaking of safe havens, treasuries, we actually saw the 2-year. It actually moved up a bit. So the yield curve essentially flattening somewhat from what a lot of people were expecting. How does that change your view of bonds, or does it at all?
No, I think there's still value across the curve. Bonds, treasuries in particular, you're not getting paid a lot for credit risk. So we're leading away from high yield in this environment. Within the fixed income space, munis muni spreads are really attractive, I think, now compared to corporates. So if you're willing to take on some additional duration and tax exempt account or taxable accounts, I'd really be looking at munis here.